Hi, my name is Robert Briscoe, and I got the Peachtree A risk and return assignment. First of all, basically T-bonds are independent of the market just because they're considered very low risk. Essentially, they're considered risk-free, even though this isn't technically correct because there's always going to be some risk associated with a security or anything like that. For instance, the U.S. government has defaulted on bonds in the past. It's very uncommon, but it could happen. And then these T-bonds are independent of the market because it's generally considered the government's not going to default. Even in a recessionary period, you're still going to have those same periods. So looking at the expected rates of return, we just basically calculated the weight, like the probability of that state of the economy times the expected return under that state, and just took the weighted average of all of them to get our expected returns. Just looking at these expected returns, it would seem that the index fund is the best investment just because it receives the highest expected return of 15%. The closest is TECO with 13.5%, but again, this doesn't take risk into account. So adding in risk, we took the standard deviation and the coefficient of variation of all the investment opportunities. I think that coefficient of variation is a better method of looking at it because it takes things in perspective. So you could have a very small expected return and a small standard deviation, but it's going to correct for having such a small number when you have the coefficient of variation, whereas the standard deviation might just seem like a very large standard deviation when in reality it's just a large mean. So looking at this coefficient of variation, it would seem that T-bonds are the best option because they have no risk. So obviously their risk and return trade-off is the best, but of those non-risk-free options, TECO seems to have the best option. So looking at just an even portfolio, 10,000 in Gold Hill and 10,000 in TECO, we would see a slightly decreased return because it's going to be kind of averaging those two returns. But what you do see is this super low standard deviation of 2.89%, the coefficient of variation down to 25.92%. This is because TECO and Gold Hill are negatively correlated, which is very good for diversification purposes because anytime Gold Hill has a bad day, TECO will have a good day. So anytime that Gold Hill or TECO is doing bad, they're offset by the other company. So looking at a portfolio where we weight 75% Gold Hill, we will see a lower expected return just because Gold Hill in general has a lower expected return than TECO. So when you weight it more heavily, it's obviously going to bring down the expected return. Again, when they're not evenly weighted, the diversification effect won't be as large, so our standard deviation will be a little bit higher than just with the even split. Then weighting it the opposite direction with 75% to TECO, we're going to have that increased return to 12.33%, and this is just because, again, TECO has that higher expected return. Obviously, as well, TECO is a little bit riskier, so you're going to have a 6.9% standard deviation, give or take. When you look at an even portfolio of just the S&P fund and TECO, you're going to see, yeah, you have this high expected return, but you also have a really high standard deviation. It's pretty risky. And the reason for that is even though you're holding two stocks, the two stocks are positively correlated. This means that there's not going to be much diversification because anytime there's a good opportunity for either of those stocks, the other stock is going to do well. But anytime there's bad news, then they're both going to do bad. So again, this is going to just essentially average the return and the risk instead of actually minimizing. Alright, so we've talked a lot about diversification. Basically, diversification is just, you don't want to hold one stock in your portfolio. If you just hold one stock, it's going to be really risky. You can't expect to receive compensation for all that risk you're taking on. So in general, you want to hold like 20 to 30 stocks. There's no exact number. And you want to look for stocks in different industries and with different correlations. That way they really will minimize each other's risk. So there's things called systematic risk and unsystematic risk, and only systematic risk is actually going to stay. You can actually diversify the unsystematic risk away. That's stuff like strikes and lawsuits, etc. So these are the security market lines for each of the stocks. The slope correlation just shows like how they move versus the market. Basically, we can see that Gold Hill is negatively correlated to the market, which is what we assumed earlier. Techo is positively correlated with the market. Again, we had talked about that. And in general, when we look at the security market line, which tracks the return versus the riskiness of the stock, we can see Techo at its current value line beta of 0.6 is above the security market line. This would indicate that that stock is undervalued as you receive a greater amount of return for the risk that you're required to take on for it. So just in general, when you're changing CAPM, anything that boosts inflation or the risk premium or the beta is going to cause increases in your rate of return as well, because all of those things make it a little bit riskier to invest in that stock. So investors are going to need a larger amount of payout for taking on that risk. The efficient market hypothesis basically just says that there's no way to beat the market because the market just updates instantly and everything's always at fair value, so there's no point in actively managing. This is just a hypothesis though, it's not a law. It's accepted with some degree of truth, but it's not the rule. So you don't necessarily have to abide entirely by it. It's just a good thing to take note of. Finally, the long-term debt to asset ratio has been decreasing for this firm. And what this means is that they're becoming less and less dependent on their debt and more on their equity. Equity is, of course, the more risky form of investment. And so in that case, you're going to see their beta increasing slightly, and as well, their return on equity will be increasing with that beta. That's it for this presentation. Thanks.